Hello student, my name is Dr. Athar Iqbal. This is last lecture of bond valuation. In this lecture, we will cover two main components of bond valuation. One is how investor obtain holding period return, and second, what is the relationship between bond price and the interest rate which is prevailing in the market. So the key points that we will discuss in today's lecture are concept of holding period return and the relationship between bond price and interest rates. Holding period return means what return a bondholder receive if he sell the bond before maturity. So to discuss it, I am showing you a question that a person who is buying a 10% annual coupon bond at a price of 1050, and we discussed earlier that bond sometime an investor will buy at a premium or at a discount depending on the prevailing yield to maturity rate and the coupon rate, and then he hold it for 1 year. I'm keeping it only for 1 year to keep the understanding simple and understandable, and then he sell it at 1085. So if you compare it with the buying price, you are buying at a price of 1050 and you are selling it at 1085. So it depends on the market behavior. Sometime the bond will be sold at higher than the buying price, and sometime it is possible that you are selling at loss depending how investor required return is shifting in the market. The question is asking what holding period return he would receive. So to calculate holding period return, the things will remain simple. Whether you are working in an estate and property, you are working in bonds, you are working in any other chapter, holding period return means the duration in which you hold the bond, what return actually you obtain. And this is only possible if you get all the cash flows under consideration. So I'm just showing you the data which is available here. So the buying price is 1050 as given in the question. Selling price is 1085, the price at which holder sold the bond, and the interest payment is 10%, and this 10% will be applied on the face value. So whenever you are calculating coupon bond interest rate, remember that you cannot apply it on the buying price or selling price. This annual coupon payment will be applied on the face value, and the face value will remain 1000. So when you will apply this 10% on the face value, your interest payment will come out 100. It means that if you carefully check the data, a person is buying at 1050, he is selling at 1085, but during this time period he is also receiving interest amount of 100. So his actual return that he is able to generate is split into two parts. The one is capital gain, the difference between the buying price and the selling price, and second, the interest amount that he received. So the formula will come like this. Might be you are feeling that the formula is quite tricky, but you can apply this kind of formula anywhere whenever you are interested to calculate your return. Here you will take the interest payment that you will receive from the company, then you will take selling price and minus buying price. These two prices may vary depending on the question, and then whatever result will come, you will divide it by the buying price. So once you will put all the information in this calculation, the payment will come as 100 we discussed earlier. Selling price is 1085 and the buying price is 1050. When you minus these two informations from selling price and buying price, then the difference might be capital gain or it might be taken as capital loss, depending whether you are selling at a higher price or lower price. So the mathematical working is important here. If selling price is more than the buying price, then the resulting difference will be positive and will be added in this one. But in case if selling price is less than the buying price, then the difference will be treated as negative and should be minus from the payment amount. And then you will get the resulting answer, and that answer is coming 12.86. So 12.86 is showing if the investor is holding this bond for 1 year, then what return he will be able to get from this investment.
Now student, this is for the understanding of those students who are thinking that we are buying bond at a certain price and how the price will behave from period to period. So keep it in mind that there are certain assumptions that will remain same. First, showing you the data that suppose the price at which you are buying will be reflected like this. Coupon rate is given in 12%, YTM is 10%, and the N is 3 years. If this is the data which is given, so in this situation, whatever price you will calculate, that price will come at premium. But as discussed in the previous lectures and in the basic understanding, where we were discussing the fundamental concepts, that at the time of maturity, company will not pay you any premium or discount. Company will only pay you the face value. It means that whatever work you are doing, it is gradually shifting to par value. Another situation which is possible when you calculate the price of the bond at discount, this situation is only possible when coupon rate is 8% and YTM is 10%. So whenever YTM is more than the coupon rate, whatever price you will calculate, that will come as discount. In both the cases, we are taking 3 years just for simplicity so that you can understand the basic theme. So one very important assumption that we are applying over here is that we are assuming that whatever YTM is in the market, it is not going to change. Investor required return will remain constant. Then the graphical presentation will be like this. Look, in the first case, we discussed that whatever price you will calculate, the price will come at premium. And this is the price that is computed over here. This price will move downward with the passage of time, and at the time of maturity after 3 years, the bond price will automatically reach to 1000. It means that if you are buying a bond at premium, so with the passage of time, the price of the bond will show a declining trend. On the other hand, if an investor is buying a bond at discount, discount means the price will emerge from here. So in this case, whatever price you will calculate, this price will move upward and price will reach to 1000. It means that if we are assuming it that the investor required return is not changing, then the price behavior will automatically either increase or decrease depending on the situation and will automatically reach to 1000 at the time of maturity. So in case of premium, prices will come down. In case of discount, price of the bond will gradually go up and will reaches to 1000.